Hey everyone, it's Ed Kime over at Quantcha, and welcome back to another day of the Quantcha Challenge. As always, we invite you to check out our $99 Quantcha Unlimited, where you get unlimited commission-free stock and option trading, as well as everything we offer in our web tools. So today we're going to start off and we're going to check out the portfolio, which has taken a bit of a hit today. As we can see, we were heavily we had kind of a high beta weighted delta when we left our position yesterday, and we've got a drop of over 1% today in the S&P, which has kind of hit us a bit. I mean, across the board, the our AMD stuff is still just waiting to expire, so that really didn't help us at all. Carnival were bullish, Microsoft were bullish, Nvidia were bullish. All three of those took big hits today. Um, it's we're not terribly concerned. I mean, Carnival and Microsoft, those two positions are kind of their stock acquisition positions, more or less. So at this point, we're not too worried about them kind of taking a bit of a hit. And maybe I wouldn't be surprised if this is a short-term drop in the market. If the U.S.-China relations get some good news tomorrow, I could see this returning pretty well. The Micron, unfortunately, did not fall hard enough to really make a positive impact for where we need them to be. We're still waiting for this one to die off. And the one that really hurt us, though, is this Nvidia trade. It expires tomorrow. Yesterday, it was up over 155 for a brief period, which was comfortably outside of our strikes. Now it's kind of gone all the way through, dropped through the bottom, and is now on the wrong side of the strikes once again. So we are bracing for a full loss at this time for this particular trade. But again, it's such a volatile stock that any good news overnight, which I wouldn't be surprised to see something said in order to sort of stem this before it gets much worse. And unfortunately, we did take a hit to the portfolio. We lost. We're down about we're down about 1.5% right now on the overall book, which is a bummer. We have been having really strong surge, but that's okay. We pretty much gave back what was this week's gain so far. And we had talked yesterday, and this is what's kind of tough about options investing is yesterday I talked quite a bit about trying to neutralize our Greeks here, especially the beta weighted delta. Um, we didn't, and we're actually not going to do it again today. I had kind of hoped to squeeze a little bit more time out before we got to Friday, and then on Friday I wanted to go through and sort of balance everything. It was a little bit irresponsible, but it's also something I didn't want to jump on the I didn't want to jump in front of a surging market. And even at this time, I guess we'll find out tomorrow whether the market is really surging, or if it's really going in for a big drop, or if it was just a temporary hit that does happen from now and again. And again, the Carnival and the Microsoft trades, I'm not too worried about because we want the stock on them. We're going to sell calls against them. We got as much premium as we could have hoped for under the circumstances, and even though we're more and more in the money, if they get a sign, we end up with the stock, we'll sell calls against it, or we'll find some way to kind of ride those down the road because we are bullish on them. And then Nvidia, this is the one, like I said, that was a real uh, tough break because it went from a full gain to a full loss overnight, and so we'll see how it ends up tomorrow. So that being said, the other thing I want to do is I didn't place a GoPro earnings trade. I had looked into doing it yesterday. At the time that when I was looking around at the market, because we have four legs to fill, it was a really nice. They were tight spreads on all the positions, and everything was a penny wide, which meant that we'd have to pay the market pricing. So the midpoint pricing we were looking at, which was about 7 or 8 cents, which would have been great to get in at, was infeasible. We were going to have to pay 10 cents a share to get in on the trade, and my main concern was that it was trading about $5, and if it moved at all, I was worried that we would get we would basically get our time value completely washed out. And what surprisingly happened was it has not really budged. As you can see, it was just like Tesla last week. We've seen virtually no change today. I mean, the market, I don't know if you'd say it's happy or indifferent or what, but I was really concerned that there would be a surge. I really thought it was going to go up $6 or $7, and I didn't want to do a strangle or a spread apart our strikes between the puts and the calls. I really wanted the calendar straddle. So skipping over the P&L, I recreated the position today based on what we would have opened just to kind of look at it, and if we pair off the calls and the puts here, you can see the spread is the spreads are still, they're a little wider than yesterday for the calls, but it's not too much, so it's still very liquid options to come trade. The main thing to note though is that they've really kind of stayed in lockstep with the drop, and the volatility drop for the near week, while it was really substantial, I think it cut in a third, down to a third of what it was yesterday. Uh, it hasn't really reflected so much in the pricing. So if we were to take a look at a trade ticket for opening this position, we can kind of think in reverse and say, if we were holding this position and we wanted to get out of it, um, this, basically if we wanted to buy in today at market price, it would cost us 18 cents. The net is 15. If we had all our positions reversed here, which I won't go through, but if we did, we went to sell it now, we'd be able to get 12 cents off of it at market price, which is really good. If we had bought in at 8 or 9 cents, I know yesterday we had looked at 8 cents as the midpoint, so at that time 10 cents was the market price. So we'd be able to sell for 12 cents, which would have been a 20-cent gain or a 20% gain overnight. But keep in mind, that is trading this straddle where we had almost zero move. I mean, you can't move any less than 1 cent in this stock. So this trade, had it actually moved in either direction, had GoPro really pushed, would not have yielded us much. And this is sort of part of the evolving strategy as we're looking in how to succeed with these calendar straddles, is to really have concern over the strike price, the price of the stock, really just the scale of the stock, like being around that single digit mark, as well as the strikes around them and what the value of the options at those strikes is for trading. So for example, in this case, the bid for this option is 20 cents. So if we held it, we'd be able to sell it for the intrinsic value plus 4 cents. And it would cost us 5 cents, this is the one we were actually short. We'd have to buy this one back at probably at 22 and sell this one at 27. So we could make 5 cents there and then hopefully 6 cents here to get 11 cents out of the trade, which would have been, again, if we had to buy in at 10 cents, would have just been 11 cents. So this continues to evolve. We might go into the screeners now and actually take our earnings one day and make a little change to it where we're going to look at the general pricing. We might change the equity price to say, look, we want at least something that's between like 20 and, or that's at least, let's say, $50 is probably a good decision to make there, and then we'll save that. Just because those small dollar ones are a little bit tricky to trade, because the options don't, when they crush, the options don't necessarily yield the kind of crush we're hoping for. And even though in this particular case we would have made a little bit of a profit, I'm glad that we followed my gut there and didn't actually close out that trade, because the risk was not worth it. Now today there's one stock that meets our criteria, which is today's the last day to trade before earnings. They're at least $50 per share, good liquidity for the options, and they have weekly options. Now I've already looked through this Hasbro trade, and my gut is that we're not gonna trade it, partly because the weekly vol being tomorrow is 135 ish, and it's about 135 it's about 35 for the long-term volatility. So even though the crush is showing that it should come down to 36, the long-term volatility mean right now is 33, which means it's really they're not very rich options. They're pretty accurately priced. And the other problem is that if we take a look at, for example, we go to the option chain for this particular one, even though it is technically, actually these aren't even that liquid. The liquidity must come from later on, from other parts of the chain, closer to the 30-day mark. But even if they were liquid, so the scenario we worry about here is we've got this price of, let's say, $90 if we went at the 90. So let's say 380 is the fair market value for the at the money call. If we went out a week, the fair market value for the at the money call is going to be 430. So that's 50 cents there. Now, that 50 cents comparably, if you were to divide this by 20 to get down to the, that $5-ish range we were looking at, that 50 cents range here is a 2.5 cent spread, which tells us that relative to the trade we were looking at yesterday, we'd be, if we could have gotten the trade yesterday at 5 cents for the calendar straddle on GoPro trading at $5, that would have been a more lucrative opportunity. We could have at least day traded or adjusted our positions out of that to try to make a profit. But when you're dealing with the larger numbers here, this spread here means that if we have to buy in at this value, like for example, if we have to buy in at the 440 and sell off at the 420 for the options at earnings, we're looking at, for example, these options tomorrow. Um, the bid ask spread here this is huge for an at the money week of options uh, option here. So this is the expiration week at the money option, as I've said, and it's a 40 cent. So it's a 10% strike width there, 10% spread width rather, which is just too much. There really wouldn't be a profit opportunity, I don't believe, if we bought these and even if as we shave them in, if we did the same thing here for the puts that are also right around 10%. I don't think there's enough potential there, because when you model that trade out, you also have to account for the fact that the crush we're going to see here is that if we go back to the term view, this week's options, these are going to go from 135 to about 35, which means they're going to be crushed to about a quarter of their current volatility. But the weeklies for next week are going to be crushed to about half of the volatility. And again, this is just sort of an evolving strategy we're working on with these calendar spreads. There's probably a way to make money here, especially if we don't expect Hasbro to have a significant move. But when they missed earnings last time around, last quarter, they dropped almost 10%. So it would be very, very difficult for us to look at a stock that's trading at this 35 volatility and expect that options that aren't right at the money to have weekly value for next week. And one of the ways I like to kind of analyze that is if we take a look at the 30-day volatility here. So if we come out to let's take our the IV, let's specifically take IV percentile. And IV percentile at 30 days is about 90%, which means that this price here, this relative volatility, is this is higher than 90% of the volatilities over the past year. So we know that this 45, and even if we went further out, we'd probably see numbers that are even lower. We're looking at a 35 long-term volatility for the implied volatility here, but realistically, as you go further out, you'll see it gets even lower. And after the crush happens, it's probably going to be around 25% volatility. So what a good idea to do is, before you get into one of these calendar calendar strangle trades or a calendar straddle, is to go out to the stock screener, change the earnings to say, let's say something that's at least 20 days out, and then at least $50 to be comparable. And then we're going to change the implied volatility to be, let's say, 23 to 27%. And what we're going to do here is we're looking for a comparable stock that's like the one we're looking at trading, that has weekly options with good liquidity and so on. And we want to see, after the crush happens tomorrow, if we look at options that are going to lower down to 25, what will they be worth if they're 10% out of the money? So if we just took, we'll just take one that's a little closer to the pricing we're looking at. Here we go. PayPal. This is a very similar profile to the company we were looking at before with Hasbro in terms of volatility and absolute stock price and so on. So if we come in and we take the weekly options, the ones that expire tomorrow, and we take a look at the option chain, we can see that if Hasbro doesn't move, right, and it crushes down to this 25-ish volatility, we should still expect to pay about 70 cents, or have to pay 74 cents to buy back our at-the-money call. And that's the best case scenario for us, is if the stock doesn't move. However, if we went out to next week's options and we go back and we find that 91, this is going to be $1.54 is what we're going to get for it. So at that point, that $1.54, and if you subtract from that the 74 here, we're looking at about 80 cents in value. Now, if you remember from before, we have to pay in order to buy these options. This would cost us like 50 or 80 cents, somewhere in that range. So most of the value that we'd hope to get would be off the crush, and then losing more time value from these at-the-money options for the short week than we'd keep more at-the-money time value for the long week. And this might be difficult to follow, but we've talked about this a ton over the past couple weeks with the calendar straddle strategy. So the net of it is to say, in this case, it might be worth it, because if you could see that it would retain about 80 cents, let's say, of value if it stayed at the money. If you really believe that that Hasbro trade was going to stay at the money and you could buy the call spread for, let's say, 40 cents, then you would expect that if it didn't move, you'd be able to about double your money, because looking at a comparable stock that doesn't have the earnings volatility, these are the rough pricings that we'd expect to see tomorrow after the volatility clears up. So I know it's kind of a long walk to go through, but I wanted to share that we don't have good tools at this time for simplifying that process. The best thing we have is our book manager, but the challenge with the book manager is, if we come to it, when it crushes down on the volatility, it will use our forward modeling pricing to figure out what the option should be worth at a future date, and that pricing is often not that accurate, because we only model the future volatility for expirations down the road based on the current volatility surface. And the whole premise behind trading these calendar spreads is that we expect that the volatility surface is giving us some kind of yield that we can pull off of it, because we think that the rise or fall volatility expirations are wrong. So again, just as a recommendation, check out what a comparable stock is that doesn't have that earnings volatility, to figure out what kind of spread you could expect to see after the earnings are cleared up. And I hope that makes sense. And as always, if you have any questions about that, please leave us a comment, or you can hit us up at hello@quantcha.com. But today we are going to just we're going to bow out today. We're not going to make any adjustments or trades. We're expecting to do a little bit more tomorrow to try to get ourselves in line with once we kind of see where the market's going. I mean, in the event we see another big drop tomorrow, if we see another 1% down day, that's going to hurt us quite a bit for a couple of our positions, primarily the Carnival and Microsoft positions. It'll continue to kind of push off some of that value. But on the upside, we'll own stock that we would have bought otherwise, and we'll have gotten it at a bit of a discount. So wrapping things up, hope everyone's having a good day, taking advantage of some of this volatility. And as always, good luck and good hunting.